any particular position.
Right.
There is no wrong portfolio. It's simply, the way I view it, it gives power to the advisor and it gives power to the end client to determine this is a portfolio that fits me, fits my needs, and fits my goals. Dimensions just help us to fine tune those expectations.
Welcome to Wealth and Life, where you'll learn with financial planner, consultant, speaker, and business owner, Tony D'Amico. You'll hear stories from successful business owners and individuals about how they navigated the inevitable challenges that arose as they achieved each new level of success. And you'll get insights and strategies from leading wealth planning professionals on how to achieve your next level of success. Now here's your host, Tony D'Amico.
Well, Christian, welcome to the Wealth and Life podcast. I'm really excited to have you on today. And to our guest, Christian Newton is a vice president at Dimensional Fund Advisors, part of their global client group, has been there for 17 years and have had several different roles, worked in several of their different offices, and plays a really key role in really working with financial advisory firms out there to share about Dimensional and what they do and their investment philosophy. So super excited to have you on today, Christian. And
thank you.
Also just, a little bit about Dimensional for our listeners before we jump in. Dimensional Fund Advisors has been around for almost 40 years, and
Right.
They've been working with advisors for about 30 years. So you guys manage about $500 billion in assets, so about $500 billion in assets. And other really interesting points too, over a 20-year period, while most equity and fixed income funds, only 17% of them outperform their benchmarks. With you guys, a little over 80% of your funds do better than their benchmark. And, really pumped to get into this because obviously you guys are a top-notch institutional investment manager, and we really appreciate the partnership. And obviously we use your funds for a portion of our portfolios. I think the other thing too to throw out about you guys is that there's about 300,000 registered advisors in the country, and you guys work with less than 5,000 of them. Only about a little less than 2% of the advisor population. So, I think that's really great. And, I guess, Christian, to kind of kick things off, again, welcome. But so why is Dimensional so selective on the advisory firms that they work with?
I'm sure your numbers are right. So there is clearly a selection activity happening there. Not to be contrary, just coming off the bat, because I really appreciate your introduction, all accurate. But I think it's not necessarily Dimensional that's being selective. What I would say to counter that is that the philosophy that Dimensional brings to life, the point of view about investing, about capital markets, stocks and bonds, what we as investors can do, what forces we can harness to improve outcomes for all of us, that is a body of philosophy. Put another way, a set of ideas Dimensional absolutely subscribes to. And something that we're looking for, like you might expect, is that we're looking for a similar set of ideas, a similar perspective, a similar philosophy from the advisors that we're going to work with. So I would say in a lot of ways, I think the thing that does the selection is that philosophy, that approach, because something that, as I know that you know this, there are many different ways to invest, a ton of different ways to skin the cat. The philosophy that I know your firm and my firm, Dimensional, has in common, the philosophy that we share, is shared by many, many other financial advisors, but not everybody. Not everybody views the world or invests on behalf of clients the way that we do or your firm does. And so I would say that that selectiveness is really a function of whether the advisor, our client, Dimensional's client, buys into the philosophy, again, agrees with the, kind of the empirical evidence of where returns come from, which we may touch on. If they agree with kind of philosophically, how do I put, the interest of my client first? How can I maximize good quality outcomes for those clients? Again, getting a reasonable return for a reasonable appetite of risk, a belief that ideas like risk and return are probably related. When you have competitive capital markets like we do. So I think what we're always looking for is that common belief system.
Mm-hmm.
I wouldn't say it's a set of requirements. We're not, evaluating or approving advisors. I mean, what I will say is to rewind all the way back to the history of the firm, founded primarily by David Booth. David's vision for the firm was to make available investment strategies to everyone. And even when we were working with institutional clients, there was an appetite for strategies a lot of other managers simply didn't offer. That's where we pioneered our first strategies. And a lot of our clients back then were pension funds. And naturally, as everyone knows, pension funds are full of assets that are intended to match the liability down the road to pay out pension benefits to beneficiaries. So even though we were working with institutional clients, what we were really doing was funding and caring for the assets that were going to be in the form of pension to a lot of people kind of down the road. And as we've evolved, kind of as the workplace has evolved, as probably everyone recognizes, pensions are harder to find. It's quite unlikely that people get pensions it's quite unlikely that people get pensions in the private sector. More often people are managing their own money or have the option of managing their own money. And so that's where our work with advisors really came from, is that suddenly the financial advisor business had really mushroomed starting in the 80s, going into the 90s, into today. And again, that's where we can benefit those end investors by partnering with advisors. So we want to be there. So, philosophically, I think David would say, we want our strategies to be available to as many like-minded people as possible. I think the key there is the like-mindedness, that we do share a view of where success comes from in investing, and not everybody shares that.
Yeah, that's really interesting. So there's a little bit of a self-selection process, right? Advisory firms might self-select out because they're not like-minded or they don't share that same philosophy. And so that's really interesting too, how you guys started primarily with pensions, but then as the landscape changed, you made your your funds available to those avenues. So Christian, I guess, how would you describe, because I obviously understand the philosophy at Dimensional really well, and there's certain aspects of the market that you guys have an excellent long-term track record, but how would you describe your investment philosophy?
Well, to me, the heart of the philosophy is the idea that capital markets are very competitive, and our belief that markets work. That is, put another way, that the effort that capital markets do in pricing securities, right? Every day the stock market opens and counterparties come together, buyers and sellers come together, all of them in kind of a friendly disagreement about the right price, the price that will motivate them to sell a share of a company or buy a share of a company. And the changes in prices, our view is, in a very competitive market, are a great source of information about what we can expect going forward. Put another way, the prices markets generate today give us really valuable information about the returns we should expect going forward. And when I say really valuable information, which is kind of a technical way of putting it, what I mean is we can measure the market today, measure the prices of all of those investment options, all of the different stocks that are available to us in the market, and we can articulate portfolios where we have a positive expectation that we will not only deliver, let's say, the return of the total stock market. We might often call that a benchmark return or the return, say, of an index, but we can expect to go beyond the return of the total stock market. That is, delivering a higher expected return than the stock market, all by measuring the market today, measuring prices today to give us information about the future. Again, that idea is really essential to our worldview. Our worldview says we as investment advisors managing a mutual fund do not need to articulate a prediction about the future. We don't need to articulate a forecast of what's going to happen tomorrow. We don't need to have a forecast about the price of a particular company. We don't need to have a forecast about macroeconomic conditions, good or bad news happening in the world. Rather, what we can do is we can allow the market to price those uncertainties, look to the price today to, again, give us information about tomorrow. That view of how markets work, the utility of that information, and the idea that you don't need to have an opinion about the price of a company, oh, that price is too high, that price is too low, or maybe more broadly, and in a kind of more accessible example, I don't need to have an opinion of how the market as a whole will do tomorrow, or the day after that, or the day after that, or even a week or a quarter or a year in the future. Rather, I can put the academic evidence about how markets work, where returns come from, to work for me and not have to have any forecast at all. That doesn't mean I'm going to invest, kind of irrationally. It doesn't mean I'm going to ignore a lot of important investment choices, but rather those investment choices are going to be baked into an investment plan. And again, that investment plan is probably going to tap into, if you're using dimensional strategies, it absolutely is tapping into this idea that the market is better at pricing securities. I'll put that another way, assessing all the uncertainty, either macroeconomic or specific to a company, about every single investment opportunity in the market. We would argue the market's better at pricing that than any one expert. And I think that's really what sets us apart. Not many other firms invest the way we do, because again, there's no forecast. If you own a dimensional strategy, you're not paying us for some idea of what's going to happen tomorrow. Rather, you're buying this strategy that looks to the market every day to determine, in a sense, what we should own tomorrow.
And Christian, that's really great and helpful to our listeners. And that academic or evidence-based approach where there's research, right, that has determined what are the dimensions that you can look at that are determinants of future returns or exceeding, or future expected returns, and how to enhance them, right? So it's that whole academic evidence-based approach. Knowing what those dimensions are is really important. So there are, that long-term approach where, we know over the long term that stocks do better than bonds. But do you want to talk a little bit about the different dimensions that have been identified as that they've been persistent and they could be traded on? Because those are all, and I don't want to segue, right? Those are all important factors too, right?
For sure.
Can it be executed on in a cost-effective manner? But yeah, talk a little bit about maybe some of those dimensions that are looked at when purchasing either stocks or bonds.
Yeah, so this idea of a dimension, the way I think of it is, it's just like in kind of three-dimensional space, or what we might call Euclidean space. A dimension means I can move left or right? Or I can move up or down. I can move forward and back. Those are the three dimensions that we as human beings are accustomed to. And that's exactly kind of what the research coming out of an academic view into finance, that is sort of answering the question, where do returns come from and why? And that is, I view that as a scientific enterprise. I would say, finance and economics generally, it is a social science, but especially econometrics, which is sort of the tradition of, again, measuring the market, measuring capital structure, measuring economic activity in order to determine empirical insights. And that's a key difference. Empirical insights meaning something we measured out in the world, something we measured in the returns of one set of stocks versus the return of another. It's not simply a theoretical idea. It's been measured historically. That's literally what empirical means. So putting this empirical research to work expresses itself in this idea of dimensions. So what is a dimension? A dimension simply is a measurement I can use today, looking at stocks or bonds today, to have a sense for what it's likely to behave like in the future. Put another way, I can use a measurement today to form a basket of stocks where I have a strong expectation over time and over the long haul, they will have one particular type of return. And I now have another basket of stocks that have a different measurement that's going to have a significantly different return over time. We call that systematic returns, meaning it is a return that comes not from owning a single company, where, of course, if I have an investment portfolio that's formed of a single company, like you would guess, I am significantly invested in the human capital risk of that company. A single product, a single fabrication line fails, I'm probably going to suffer negative returns because of that one company. If rather I own 500 companies or 1,000 companies or 10,000 companies, we call that diversification. Rather than concentrating my ownership, I spread my ownership out. In fact, you could argue, I want to spread my ownership out to every market in the world that is competitive, where every day there's an auction, a competition about what the right price is. Now I own thousands of stocks. With those big numbers, with those thousands of stocks, I can use these measurements, these dimensions, to say, this basket of stocks, if I look at the empirical research, has a lower return over time This other basket has a higher return over time. And those return differences can be big. And when I say big, I say maybe I might articulate, just to make one up, maybe 1% a year on average over a 20 or 30 or 40 year investment lifespan. And 1% a year, it doesn't sound like a lot. 1% difference in height or weight doesn't sound like a lot, but 1% difference compounded every year over 20 or 30 or 40 years, those are really big differences in terminal wealth.
Yeah, a staggering amount of money.
Exactly. So the academic research where these dimensions were identified, and I want to impress upon you that these are not proprietary to Dimensional. That's not it's not a black box. It's not a trade secret of Dimensionals. These ideas were identified and published in academic journals, many of them in the 1970s, 1980s, 1990s. That work, in fact, continues today, identifying these differences in returns. So often when we're talking about application, when we're talking about the strategies that Dimensional manages that tap into these, we'll talk about the dimensions and the primary dimensions that we form portfolios around. Again, where we're going to kind of adjust those weights to different buckets based on different measurements in the market today are going to be what we call size. That is, how big is the company? And I don't mean by employees or sales, although those are metrics you can use. Traditionally, the metric we use is market capitalization, which is simply what is the total worth of this company based on market opinion today. I want to take the stock price today times all the shares outstanding in the universe. That tells me the market capitalization of the company. And that is one of the dimensions. Now, that all sounds pretty straightforward, but this is what is often counterintuitive for folks, is that if I compare returns of small companies, companies that have low capitalization, versus returns of big companies, companies that have really big capitalization, and to make a caricature out of it, big cap companies are usually companies we've heard of. I won't use any names, I think, for today's purposes, but big companies you've heard of, they've been around forever, really successful. You see their logos and products everywhere. Those companies often have large capitalizations. If I look at those two baskets, large and small, and I hold them over 20 or 30 or 40 years, even just a couple of years, over time, the basket of small cap companies delivers a better return. Now, that is a counterintuitive idea, I think, for a lot of people. And to some degree, that's a big part of my job, because these academic ideas do run counter to people's intuition. We want to make sure people are educated about what to expect if they're going to invest in these kinds of strategies. So this is a long answer to a very simple question. That's just one dimension. How big is the company? And very briefly, I'll mention another dimension before I throw it back to you. What is the ratio of the price of the company today versus what it might be worth if you just kind of liquidated it, if you just sold it at auction? What's the book value of a company? Now, that ratio, the price that the market puts on the company versus, again, the book value of a company, can be really useful for giving us a sense, to put it into kind of plain English, of how expensive the company is. You can have two companies, they're both retailers, they both own the same amount of land, they both have the same number of cash registers. If you liquidated them tomorrow, they'd more or less have the same value, but one, based on its market price, is much, much bigger. And usually that's because, again, it's a company that's doing better, has better sales, maybe has a better product, maybe just has a better business model. For whatever reason it is, and that's a key idea, is we don't always know why the market prices a security the way it does, but we do know the price every day. For whatever reason, that stock is more expensive to buy per unit of its book value versus another stock that's actually really cheap, that's actually been deeply discounted per unit of book value. That ratio, we call it a ratio, again, it's really just another measurement coming out of daily prices in the market, gives us further still information about which basket of stocks we expect to deliver a higher expected return going forward, and which we expect to have a lower expected return going forward. So the dimensions give us as investors a lot of ability to control a really important idea, which is kind of how much risk do I want to take on? How different do I want my investment maybe to look than, say, the market as a whole? And what kind of a return should I expect as I do my planning and my wealth planning, as I figure out my goals? And, I feel like every investor, and most investors have, but I think it's worth reflecting on, ask themselves, why am I investing at all? Is there a well-articulated goal that's driving these decisions? And again, usually when an advisor is working with a client, that goal has been defined. I feel like that goal usually determines the degree to which an investor might use some of these dimensions. And again, just like a dimension of movement, you're kind of free to choose any particular position.
Right.
There is no wrong portfolio. It's simply, the way I view it, it gives power to the advisor and it gives power to the end client to determine this is a portfolio that fits me, fits my needs, and fits my goals. Dimensions just help us to fine tune those expectations.
Sure. And Christian, you took the words out of my mouth, right? So I know that you guys use size as a dimension, the size of the company, the price in consideration of the book value, right? The profitability of the company. And
that's a third, right?
Yeah. You have all these dimensions that you apply to stock selection to, improve expected rates of return. So very important, and with bonds, you're looking at what term and credit, right?
That's right.
Bonds and there's certain evidence there in the data, in the long-term data. So very valuable stuff. But the most important thing that you just said is that you're not investing for the sake of investing. You're investing because you have goals. They could be short-term goals. They could be longer-term goals. So that is just so important. Our philosophy is to start with a financial plan. So number one is to create a comprehensive financial life plan for someone before we recommend their asset allocation and how to invest, right? Because you're right, those dimensions are very important, a very key piece, but it's all about helping them have a financial plan that has the highest probability of success. So how do those investments support the financial plan? Very important. I mean, historically, as our industry has evolved quite a bit, the last 30 years, but in the old days, it was just, people would fill out a risk profile questionnaire and that's how they develop their asset allocation. But
right.
And we still do that. It's a tool, but the financial plan is their investments need to be benchmarked to that just as much, if not more than a risk profile questionnaire. So that's, all really, I'm glad that you shared all that because that's, really, really helpful. And it's all about trying to improve probabilities, right? There's no guarantees, but it's all about, probabilities. And, if I could, I want to kind of switch this a little bit.
Sure.
Or kind of talk about, there's other things that you guys do that we can talk about, but let's jump for a minute. Let's talk about practical stuff because we're filming this May 27th, 2020, right?
You don't have to remind me. It's been a unique year.
Very unique, right? We have COVID-19, but yet in my opinion, there are undeniable investment principles that you have to keep in mind. Now, are there other ways to invest that can be successful? There are. Do I believe the way that we invest kind of has the greatest degree of probability? I do. As a fiduciary, obviously would adjust it if I felt otherwise, right? And but let's, I guess, just about current events. I mean, in March, right, the markets fell so quickly, very quickly, at one of the quickest rates in history.
Yeah.
Right. And, part of this, philosophy from our standpoint is trust in the capital markets. We know the markets in the short term are very irrational. So what does that mean? So to us, that it means that the movements aren't predicated on anything that means anything. It's completely irrational, right? So markets are irrational in the short term. Over the long term, right, we have expectations that the value of a share will reflect the value of the investment. But one of those, so that comes to mind as, to me, an undeniable investment principle that in the short term markets can be irrational. So as one of your academic consultants call it, it's a random walk in the short term, right? I'm kind of getting technical.
Right.
But I think what I'm kind of getting at too, which I think this is really important. So the markets were terrible in March, right? And what do? I mean, we viewed it as an opportunity to rebalance our client accounts. Now, we're not talking about doing something tactical and changing strategy, but if a client was 60% stocks and 40% bonds, and their 60% stocks became 50 because stocks dropped, bonds have done well the past 12 months. We sold the winners to buy the losers, which in most cases was selling off bond funds to buy stock funds while the prices were lower, right? We don't know if it's a rock bottom sale, but we know it's on sale relative to the price that it was in February. So,
for sure,
we rebalanced a total of 6 times, which I think is imperative, right? You guys manage a lot of money, right? So up to the crisis, we managed about a $250 million of assets before COVID-19 set out, but you have to have it scripted out. You have to know in your head, what's the investment philosophy? How does it support our clients' financial life plans? What will I do if something like this happens?
Right.
And then you have to do it. But and I'm kind of talking freely here. But then April happened. So April was one of the best months in the market in the past 30 years. So
right,
you can knock the whole thing. Oh, long-term discipline, stay disciplined. Well, you know what? That kind of is really important. And it kind of surfaced here again. And I'm thankful, out of the, 200 plus households that we serve, we didn't have anyone that broke discipline. Did we have to have some calls? Yeah. And that's what we're here to do. We're happy to do it. But, we know, and you guys have this data as well, we know that if you react, right, to the markets dropping, and if you just miss a few of those days, because we know the best days happen right after the worst days. And I don't mean to rant here too long.
They often come together. Yeah.
Yeah. Not always, right? But the best days happen after the worst days. And if you miss those best days, then it hurts your return. And if it hurts your return, what is that doing? It's basically going to mean that you have to reduce your lifestyle in the future or change your goals. But I want to get your take on this, but going through this and executing this for our clients and helping them stay the course, I just think that there's a handful of undeniable investment principles that rose to the surface again. And what's your thoughts on that?
Yeah, I think you're spot on. I would say that March and April were, it's nice to use the past tense, were, I think, a crucible for a lot of investors, a test of investor discipline. Because exactly like you articulated, suddenly markets changed, and they changed a lot. And for some people, understandably, that creates anxiety or fear. And why does it create anxiety or fear? Well, because they have wealth in the market, and now their wealth has been discounted. Why does that upset them? Well, because that wealth means something to them. That's going to allow them to pursue charitable giving, put a grandchild through medical school, whatever it may be. That wealth has meaning. So naturally, we associate an emotional response to that change in the one-day valuation of every share of every stock in the world. And this is something that I always talk about with retail investors, is this idea that every day we are peppered with the price of all of these investments today. Every day, if you turn on the NBC News, Lester Holt will tell you how the S&P 500 did, which, by the way, is not the total stock market. It's just 500 kind of famous companies. But you could do worse as a proxy for how the market did. And he'll tell you how that S&P 500 did. Every day you get a new reminder. When the stocks are up, well, guess what? Part of you has a little bit of a greed trigger, perhaps, because now you are more wealthy by 1.5%. You did nothing. You just went to work, did your commute, took care of your kids. You're 1.5% wealthy. Well, that feels good. But then, of course, on a down day, especially days that are violently down, we're now suddenly 7, 8, 9, 10, 12% less wealthy. On paper, it is not a realized loss. Naturally, we're going to react emotionally. But this is the one thing I'll challenge in your narrative, which I otherwise agreed with, was the notion that markets in the short term are irrational. The only way I would soften that is I would say they have the potential to be irrational. But I think one of the challenges for us as investors is the way that markets are pricing securities today often is in conflict with the headlines that we see today or the day before, right? So yes, in February and March, as we were seeing that the coronavirus was A, going to be really dangerous for the United States, B, probably require, I'll call it a domestic wartime footing. And by that, I mean a significant scrambling of the relationship between government, free enterprise, labor, capital, et cetera. All bets are off. People aren't going to work. We all know what that's felt like. But because of that, suddenly the market drops, and it drops quickly. I don't agree with the idea that those fast changes are always irrational. After all, you have all these counterparties in the market. They all have different ideas, different estimates, different guesses maybe at where the market is going. But the market as a whole, I think we can agree, is forward-looking. People in the market are trying to figure out, well, what is the return on a company that's in the cruise business? What's the return on a company that's in the mass retail business? What's the return on a company in the airline business going to be? Because when we have this new news that we know is going to affect these industries in different ways, suddenly maybe there's a new level of profitability, new set of revenue, new set of sales for all those companies. Change means new prices, and those prices are forward looking. So the same way that those discounts happened and happened quickly and were kind of disappointing, on some level, it made sense to me because the headlines were quite scary at that time. But then a month later, I think we sort of had the opposite situation where markets, again, are they looking to next quarter? Probably. Are they looking 2 or 3 quarters out? Well, some market participants are. After all, that is one of the great things about markets is nobody controls them. Everyone is free to transact or not. All that volume that happens in the market every day is free enterprise, free activity by independent parties. No one controls those prices. And because of that, we can harness that information. And again, sometimes you have the market going up even when the headlines are bad. And that again is the catch for me is we get these prices every day. What we don't get is a perfect explanation of why the price changed. Because again, nobody controls it. Nobody can truly tell us. And the media does this all the time. They'll say prices dropped because of this news or this action by the Fed. And there's probably correlation, but you can never claim to know what every market participant was doing on any market day. I'll close this thought with, I'll limit myself to one Godfather quote in our conversation today, but I think this one is apropos. So if you know The Godfather as well as I do, it's one of my favorite movies. You know, early in the movie, when Tom Hayden, the Don's attorney, goes to Hollywood and he asks a famous producer to cast a friend of the Don in an upcoming movie. And the producer, in a very colorful way, which I won't repeat here, declines. He says no. And so the attorney gets up, they're having dinner, and he says, well, thank you for the pleasant meal. If you could have someone drive me to the airport, I'm going to fly back to New York tonight. And the producer says, well, what's the rush? And Tom says, well, the Don likes to get bad news right away. And I feel like the stock market is the same way. It responds to bad news right away. Yes, the market dropped quickly in one day. If you look at that day's chart, most of that price change happened within just a couple of minutes of open and with a couple of minutes of close. The market moves that fast. And again, to me, those are the stakes for us as investors. Like we said at the beginning of our conversation, not everyone invests this way. Not everyone trusts prices. Not everyone trusts markets. Some people want to go out into markets and speculate and concentrate and time the markets. And we can all understand why, because if you can do it successfully over and over and over again, if you can be smarter than every other counterparty in the market, and to me, those are really the stakes, over and over and over again, we can make a lot of capital really, really quickly. But there exists this powerful alternative that, again, comes out of academic research that says we can actually have very reliable outcomes. Like you said, they're not guarantees. That's an insurance product, not an investment product. Investment, by definition, means I am paying to take on a risk from someone else. The risk means I may be compensated positively. It also means I may suffer a loss. That can never be removed from the act of investing. But this alternative to diversify, to not respond, like you talked about, and that notion of rebalancing, to me, I think so many investors forget about the power of rebalancing. That's why I call it your investment plan as an autopilot. And rebalancing, again, like you said, it is a purely mechanical activity. Automatically, what is it doing? Well, it's selling one set of assets and buying another. It's selling high and buying low. It is literally doing what you do to invest successfully. And because it is detached from our emotional response, or again, from what we might respond to in a headline or you know, a chyron on cable TV, we're putting the odds of success in our favor if we can be disciplined over the long haul. And so that's why, not to make a caricature out of it, but to me, if someone has good wealth goals, like you mentioned, if they have an investment plan that is a function of those goals, and they have the time, and a good plan always includes the amount of time I have until I need to turn that investment into some kind of consumption, whether I buy a yacht or, sponsor a charity, university, or whatever I'm going to do with that money. Eventually, every investment becomes consumption, at least in my belief. So, that time horizon allows us to not have to respond, in an emergency. And I limited myself to one Godfather quote. I'll limit myself to one Warren Buffett quote as well. And Warren has famously said, among other things, capital markets exist to reward the patient at the expense of the impatient. And I want to be careful with that quote, because Warren is not saying impatient people are stupid. He's simply saying they need to get out now. And if you want to get out now, you pay a premium for that. You have to pay someone else their price, not yours, in order to transact today. And that idea, to me, kind of extended day after day, quarter after quarter, year after year. For those of us, people like me who, I very successful career, very proud of, but I still need to put my capital to work to have the kind of retirement I would like. I need to have that discipline every day, not to respond, not to react. And a good investment plan allows us to navigate through March and April and May. And in my estimation, it will allow us to get through the rest of this year. You heard no prediction from me over what that year is going to look like, but it will allow us to invest with confidence.
Yeah, it's a long-term plan. And I love some of the distinctions that you just mentioned. So kind of going back to the short term, what I hear you saying is that the markets can be irrational in the short term. They have the potential to be, but they're not always, but sometimes they can be. Is that kind of what you're saying?
Well, I mean, at the end of the day, what's a capital market made of? It's kind of the punchline to the movie Soylent Green, if anyone out there is a fan of Heston's science fiction. Right? It's made of people. Markets are made of people trading and transacting and acting. People on behalf of other institutions or other wealth funds, whatever it is. It's always people. So yes, the sum total of people can be irrational. The question really is, do I, as a single individual investor, do I have an opinion over what the right answer is? That's going to be two things: better than the market's price, and eventually the market has to agree with me. If the market never agrees with my idea, I'm out of the money forever. So I will definitely agree that individuals can be irrational. Even big collections of people can be irrational. I think our notion is that if you give investing, and you could broaden it and say, if you're giving capitalism, and I would say, if you're an investor, but you don't really buy into capitalism, that may be kind of a tough fit for you. But if you believe in the idea that you can put your capital to work with an expectation, not a guarantee, but an expectation of a reward on that capital, that you can invest over the long haul, and you can ignore those short-term, like you called it, which I think is a great label for it, noise, and that's a big part of what the academics have done. It's a big part of what Dimensional does in the investment vehicles themselves, is basically help to separate the noise from the signal. The signal is the kind of stuff like, how big is this company? Is it big or small? That gives me information about the future. Is it a value company or a growth company? Does it have high profitability or low? Those are all signal data that we use every day. The noise is everything else. The movement of an individual company,
so perhaps there's
analysts' opinions of companies and so forth.
Or maybe there's a lot of selling one day out of fear about the coronavirus. Now, like what you said, we can speculate that's why maybe there was a sell-off that day, but we don't know for sure, right?
And that's the thing, right? I mean, I feel like people often talk about the market like it's a god, right? Like the gods are angry today, and Poseidon threw a trident. I guess that's the Poseidon's weapon. The gods are angry, and here's why, right? And I feel like, again, I think it's kind of a natural thing to do. I'll go back to this. One of kind of the big analogies that I share with investors is that I view capital markets like a force of nature. They are not a force of nature. They are an invention of humankind. I think maybe one of the most interesting inventions we've ever created. But again, like a force of nature, who controls the weather? Nobody. Who controls geothermal activity? Nobody controls it. Despite that, we can harness those powers. Can those powers in the wrong place at the wrong time, like getting struck by lightning, injure us? They can. but we can, again, protect ourselves against those unusual events and harness over time these really powerful forces. One of the analogies I've used with people is the way I view a diversified investment strategy that owns every public company on earth, more or less, every company we can find where every day we can get a good price of what the market thinks it's worth. To me, that's like setting up a windmill in front of all of these operating companies on planet Earth. Now, for which company tomorrow will the wind be blowing really well? I have no idea. I don't have a prediction there. I'm not in that business. We believe that's simply too difficult to do because, of course, what is the market doing every day? It's pricing in those expectations. Every day, those, in a sense, those predictions are worthless because you have a new set of prices. So this idea that harness a natural force without having to take those risks, I think is really positive. Yeah. But I think, again, because nobody controls these forces, people often kind of treat them like, again, sort of the behavior of, sort of Greek or Roman gods or something. And we make up a story about why they're doing what they're doing. But nobody on TV, not even any academic, I think, worth their salt is going to claim they have that magical logic of why the price was the price that it was, because it is simply too big and too chaotic. And because, again, nobody controls it. Nobody's ever forced to trade. And like you said there, on a day, there are more sellers than buyers is what they say, which is another way of saying prices dropped. But every day, by definition, every seller has a buyer, right? That represents a new price at which one person said, I got to get out. I no longer want to own this particular stock. And someone else said, well, I'll buy it. You got to wait a little bit. But if you get to this price, I'm happy to buy it at that price. That's what happens every day. So yes, there can be more selling pressure, but every day, if there was a transaction, a buyer and seller came together freely. And I think it's, you can argue that materially they both benefited from the transaction. Again, that's our view of markets, is that they are so big and so competitive. We don't have to compete in them. Rather, we can harness them and put all of that power to work for us in a lot of ways. The key is, like we're talking about, it's often not intuitive, and you almost always want to have an objective, informed participant to help you articulate what your plan should be. Because doing it yourself is difficult, because I want to argue we can never be objective about our own wealth, because that wealth plugs so much into what we want to accomplish, while we're on Earth.
Yeah, no doubt. And, I think the other thing too, that you've kind of talked about there or hinted at is that, today and for a long time, information moves very quickly, right? So there's the belief that the price today reflects kind of the sum of all known information, right? And information moves so quickly. So rather than trying to outguess the market, harness the market, know what the long-term empirical data is, and then construct the right asset allocation, which should be done very carefully to support the goals, and then stick to it, which is kind of, people might be sick of hearing, but it's, really, really important when we look at how, the markets, especially the S&P in April, had one of its best months in the past 30 years. Really, again, just that concept arose again, and the markets move fast.
Exactly.
We get, like, there's information out there that there could be a possible vaccine. So that, we don't know for sure, but that may have been the reason why the markets jumped up 3 or 4% the day that news came out. We don't know for sure, but markets move fast. So if you're not in the markets, you can't participate in that growth. And, so again, I think that concept definitely surfaced again, that the best days, not always, but often follow some of the worst days. And if you miss out on those days, because returns can be concentrated, then, you miss out. But, we've also been talking a little bit about diversification. And I think that's, another really important concept, right? And it's this whole concept that there's a statistical measure, right? Correlation, this as well as I do, that we know that certain asset classes are not going to follow one another exactly. They're going to diverge, and we want that, right? So, I think that's a really important concept. It's something that we often will re-review with a client to show them. So, we love using funds that have a high degree of asset class purity. So if we have, at any point in time, we could have 12 to 15 different funds, and they're all, different asset classes, and they're going to be doing different things, which I think is, really important. I mean, a diversified portfolio, right, will always be frustrating because intentionally, while some asset classes are doing well, others are not going to be doing well. But, I guess an example I can throw out there, and I'd love to get your feedback on this, is that I remember in April being involved in a client meeting and just looking at their asset classes over the past 12 months. Well, about 40% of their portfolio was up over the past 12 months. 60% was down.
Right.
But the point to them was they're not retired yet, but we have clients that are retired, some that are heading up to retirement.
Sure.
But my point to them was, well, if you were retired today, these assets that are up over the past 12 months, in spite of the COVID volatility, my question to them is, would you spend 30% of your portfolio this coming year? And the answer was obviously no.
Right.
So, I think that's another, I guess, an important point here is having diversified portfolios does create the opportunities for rebalancing, but also liquidity needs, right? We could sell what's up in the account. So, I like to stress that because I think there's too much focus on what the whole account is doing, right? But
rather than the moving parts.
Yeah. But you don't really experience a return until you sell it, right? So it's nice to track returns ongoing, but what's more important to me is the actual internal rate of return, not the time-weighted return.
Right.
But let me throw that your way. What's your thoughts there, Christian?
Well, yeah, I mean, diversification, if we're talking about the body of, again, the academic work, I mean, the notion of diversification, that's at the heart of modern portfolio theory. That is a Nobel Prize winning idea that has, I think, driven and hugely improved outcomes for millions of investors. But it requires diversification. Just like you said, it requires the willingness to own assets that are going to move in different ways, that are going to, that are going to go up and down. That means accepting ahead of time the idea that at times, some of my assets will go down, maybe dramatically, in their valuation in the market. Just like you pointed out, I think very astutely, I have not realized that loss. That's just what the market thinks today. I haven't touched my shares, but the market thinks X today. And it means, of course, having assets that also will go up in that time period, or we might expect them to go up. But to me, diversification is really tough because, again, it's another counterintuitive idea. Why is it counterintuitive? Because I want to argue that most of our lives as human beings, maybe put more specifically relative to wealth, most of the story of how your clients and how most investors came into their wealth to begin with was not through diversification, right? Like take me, for example. I pursue a couple of interests in high school. It turns out I'm not great at one, but I'm better at another. I have one major, I have one degree, I get one job. I moved to one city, Los Angeles. I work for one company, Dimensional. At every step, I'm concentrating. I learn more and more about Dimensional. I get more and more specialized. What am I doing? Am I diversifying? Do I have a night job? No, I'm concentrating more and more of my human capital on a smaller and smaller swatch of the universe. Why? Because I get compensated for adding value in that smaller swatch. But investing is the opposite. If you're pursuing it the way we're talking about, by concentrating, you do not access that systematic return. If I have a portfolio of 10 companies because I like their name or their products, or their CEO is a really charismatic and colorful person, I can't form a portfolio that has dimensionality. The dimensions just don't work. You need to have what we call systemized exposure. You need diversification. You want to have a portfolio of hundreds or thousands of companies. Then you can see that dramatic difference in returns, both expected and realized. But again, diversification runs counter to our experience. Most of us have one or two kids. We get married once, maybe twice. We have maybe two houses. Most of human life is a story of concentration. And especially, for people who are lucky enough to have had a great idea, founded a company, sold it for a huge liquidity event, I can't walk up to that person and say, oh yeah, your concentration was foolish, you should be diversifying. When it comes to human capital, diversification, rather concentration is terrific. But when it comes to investing, very counterintuitive, there is this option, there's this alternative where we can diversify, hold big baskets of stock. Like you said, the movement between those is running, you know, I almost often think of that as sort of the transmission of the investment plan, all those different gears moving at different speeds to accomplish different things. But it means owning everything. And to put it maybe into really almost comically stark terms, it means accepting that we're never going to have the winning portfolio. There's always going to be a sector or a country or even a dimension that's doing really well over a particular period of time. Last year, this country had the best return. Last year, this sector had the best return. If I diversify across countries and sectors and dimensions, as most investors who pursue this approach do, I'm never going to have that number one return. I'm also never going to have the lowest return, right? Because this is a mathematical identity. I'm always going to be stuck in the middle as a blend of all of those returns. So again, in a lot of ways, it doesn't emotionally feel good. But the reality is, if we want to put the odds in our favor of long-term success, to rewind it back to the core goals, if I have goals that are reasonable for me to accomplish and an advisor can create a plan to accomplish them, that plan is the autopilot. I can do nothing. I literally can do nothing for 40 years. I can pursue whatever else it is I'm passionate about. And it's like my mentor at Dimensional said, you know, thinking about, should I transact? Should I trade? Should I get out of one asset class into another? Should I go to cash? You know, they said, your wealth is like a bar of soap. The more you handle it, the less you have. And so that idea of creating a plan and leaving it alone, letting it run on autopilot, again, informed by 70 years of academic research into where do returns come from? What kind of returns should we expect? What are the risks and how are they priced? How can clients mitigate those risks? Putting all that research to work for you. But again, to me, it's like the transmission of a car. It represents hundreds of thousands of hours of engineering expertise. But I just sit in the seat and I hit one pedal and I go. And I think that's just hard for some people to kind of, you know, internalize and accept, especially I think because for most successful people who, you know, have been rewarded with some kind of a wealth, capital wealth and other kinds of wealth, that's happened through concentration. So it does take, I think, a little bit of education, and it just takes some room to decide if it's for you. And that's something that I will tell people who ask me questions or, you know, after a presentation and they say, you know, I'm just not sure this approach is for me. That may not be for you. Like other ways of investing may be a better fit for you. It's not my place to say that someone is wrong that way, but at least education allows someone to know what's going to be a good fit for them.
Yeah. I mean, Christian, I'm jotting down some notes of things I want to follow up with you on, because you said a lot of really awesome things there. So I love the twists that you bring to this conversation. But there's no doubt about it, right? You brought up a really good distinction for our listeners. Human capital, right, is not something that you typically benefit from diversifying. And that's a very, very good point. And this could be a challenging concept for somebody that sells a business and sells it for whatever it might be, 5 million, 50 million, whatever they sell their business for. That was concentrated risk. Now, you know, for a good bit of that capital, we typically see that they want to diversify. You know, maybe they just are happy with a goal of a 7% return net of fees in a moderately diversified portfolio, 7%, rule of 72. If it earns 7%, you know, it'll double every 10 years. And, that may or may not happen over a 10-year period, right? But we know long-term capital markets have rewarded and patient investors, right?
Right.
So that is a shift, and it's a difficult shift, but it does happen. So, just quite interestingly, about 2 years ago, and I'll, this is a generic example. I'll kind of change the industry, but let's say that this person owned 10 hotels. But they actually wanted to sell 2 of them to diversify. They didn't want to have all of their eggs in the hotel industry, right? So they want to diversify. I guess the point I'm trying to make is that you're right, human capital. And that's a very awesome distinction too, that typically in life with your decisions, a spouse, a children, a career, where you live, you take a concentrated approach. And you're right, it isn't for everyone. And I would say it's a core strategy. And on occasion, we'll have an ultra high net worth, perhaps investor that might want to take a concentrated risk, but
well, sure.
they also understand there's a high degree of risk there.
Yeah. I mean, maybe put bluntly, they can afford for that to go to zero.
Exactly.
Right? For a lot of other investors, we're not going to commit every dollar that's going to feed and shelter us, hopefully in our old age for all of us. Mm-hmm. We probably don't want to take on that kind of outsized risk, right? Because you can only, as a friend of mine says, you can only wear one pair of pants at a time. Although perhaps, in a dare, perhaps you can put on a few more. But, so that relating the consumption with the risks that we take for the goals, to me, is just so central to the conversation that I know advisors have with clients. And to me, that there's a lot of rewarding dialogue that I know advisors surface with clients to help them think through, again, how can I refine or improve the goals, not just optimizing the investments, although that's always a goal, but also optimizing the goals. And I think when the goals are really crystal clear, at least as I've talked with a lot of advisors, and I would say this for myself as well, I think it's easier to live with the investments because I don't get distracted by that short-term stuff, and I can stay focused on, again, putting the odds in my favor, and especially being a lazy person when I don't have to do anything, when I don't, as I said, I wouldn't quote Warren Buffett twice, but I'm going to, I can skip the business section and go straight to the sports section, which of course right now is a terrible analogy.
Yeah.
But you know what I'm getting at.
I totally do.
It frees you up to not have to be preoccupied with some of this stuff because it's painful. It's painful to experience all these unrealized losses. It doesn't feel good.
Yeah. Having your investments, again, grounded in a financial plan, a wealth plan, that's the key. I mean, I couldn't agree more, but I love your distinctions that you're providing. I think that they're really valuable for our listeners. So, another topic that really is something that I want to chat with you about, and I think it's really relevant right now. So I want to talk about, I've seen you guys have a presentation where you look at these different news articles and what stocks they're going to predict they're going to be the best, and kind of have looked at that. But what really kind of, to be honest with you, bothers me lately is just like, the news, right? And how difficult, as an investor, when you turn on the news, and what I'm seeing lately is that it's the news, in my opinion, bad news sells more, right?
Yeah.
And when you turn on the news, I mean, even last night we were I won't say the name of the show, but there's this comedy show that we watched together as a family, and it's really funny. And we were just in between episodes, and the news was on in the background, and then, they had this background music, and his voice was talking I'm like, there's no way that's his natural voice. It was like you thought the world was ending. And I just have a huge issue with the news, the challenge that it presents for investors. I really think that the news, they don't report good news, in my opinion.
Yeah.
And it could be challenging. So what are some of your thoughts there?
Well, I'm not going to argue those points. I completely agree with you. I also know that, I think the news has been very, I won't say scientifically, but very carefully refined. Let's see, since the birth of television news, I feel like we're still consuming, most of us, some distilled version of that over the past, 75, 80 years. So I think the news is really well designed to catch our attention, retain that attention, and then catch it again, catch it every 5 to 7 minutes, because that's when the ads come on. I agree with you that I think less news would be helpful. The way that I often frame it for folks is I ask them to think of the news you expose yourself to like a diet. And I include certainly the paper, any magazines, Instagram, Twitter, any place where you're going to get information about the world. I don't care if it's just your friends on Facebook. I know that you're going to get exposed to news there as well. All I ask people to do is kind of just be conscious of that diet for a couple of days and ask yourself, like, again, it's kind of, to me, it's just like sort of the diet we have of foods and nutrition and calories. Is there anything that I can cut out where I might actually feel better if I did it? Because I do feel like, again, I'm not arguing that people should be uninformed citizens.
Mm-hmm.
And I'm not going to tell people which news source is right or wrong. I'm not going to go there. But what I do ask them to do is at least be conscious of all these sources. And just like you're suggesting, I think very often they're unconscious. We just have all these unconscious habits. I'm so fascinated. If you look at the history of the media, every 15 years or so, a new medium gets added,
Mm-hmm.
right? Like we have, cell phones, internet on a big PC, 15 years before that. You've got cable television. You can go back to, radio. But despite all these added media, they still all exist. You still have AM radio. You still have FM. Now there are fewer people listening, but they are still doing what they can to get a little piece of the brain share of the audience. And that's what you and I are doing right now. I mean, you and I are participating in an effort to connect with and hopefully inform and edify, to the limited degree I could do that for anyone, some perspective on what we're talking about. That's why podcasts are so popular, because they can make ideas available when someone like me is walking the dog and doing dishes or working out. At least doing the first two. I don't know, it's been a while since I've really worked out, but luckily you're only seeing me from the neck down. That's what I ask people to do, is if you kind of take a couple days and be conscious of where you're taking in news. I've done it, and I just canceled some magazines, and I won't mention the brand names either, but these are actually very, lowercase c, conservative, staid, not, to me, really appropriate news sources. But I still said to myself, I just don't need this. And I just want to simplify things and just kind of take in a little less. And I do think it's just useful, whatever people take away, to think about, especially if you feel like you are a frustrated or anxious investor. I think if anyone listening does feel like they're kind of not okay with where their investments are at right now, I would look to your news diet. And again, ask yourself, again, the stock market does not take its marching orders from the media, or vice versa, as we know. And to me, if I have to pick one, I'll put my vote in with the stock market. Again, being this vessel, doesn't get everything right every day, but on the whole, on average, doing we believe, a really good job of filtering through all the noise, giving me a good signal that I can bake into a mutual fund that benefits me, of what the future is going to hold. Again, that expected return. I think it does help to, again, think about how you can filter the media you're exposed to, because I feel like for almost all of us, it's more than we thought it was.
Mm-hmm. Yeah, that's some great stuff. And even for me, we've paid attention to it. As a family, you try to turn to the news to kind of keep yourself informed of what's happening with COVID. But then it turned into like, oh man, they're just trying to grab attention through, fear sells, right? Greed sells. They know that. And it is kind of engineered to get our attention. So yeah, I revisited that myself, and I won't name the name of the publication, but it's a very common a common newspaper that's sold out there. And they're kind of rated to be kind of in the like center, not leaning one way or another. And I read it on my iPad every morning. And so I'm really trying to engineer myself, where I get the news from, because, there's nothing worse than sitting down with your family and you're trying to maybe get caught up, but then it turns into something different. So,
I totally agree. I was simply going to say, I think to me that what you spotlighted there is, to me, it's the difference between information and wisdom, right? And sometimes there's just way too much information available to us. If we pursue it, there's no end to it. And we don't need a ton of information in order to have a wise perspective, a wise point of view. And I will say, not to, kind of talk too much about what you do, but again, the way that I know advisors, the way I've worked with advisors, part of what the advisor is there for is, if something does require attention. If there is some kind of an emergency with my wealth or my plan, well, the advisor is going to be the person who objectively determines this is something we need to look at. This is something we need to respond to. It could be regulatory, it could be estate planning, or it could be something in markets. It's not impossible. But it's so much to me of what the value of an advisor is again, being an objective source, not of just information every day, but of true wisdom. And that's always worth paying for.
Yeah, no doubt. One of my favorite Warren Buffett quotes is, be fearful when others are greedy, and be greedy when others are fearful. And,
easy to say, hard to do.
Yeah. And, it's, and I just think, I can just replay like half of March and April and just seeing the markets and just, it was time to act on those, in my opinion, undeniable investment principles that others have figured out before us. And because that's the best way to shorten the recovery time is to buy more shares when they're cheaper, right? So that's obviously our goal. Yep. And it's a long-term plan, as we've talked about. It's not a plan for 2 years. It's a plan for 20 years plus. So great. Christian, is there anything that we didn't talk about today that you wanted to chat about? I know we went a little bit
how
longer.
much time do you have? No, I'm just kidding. I mean, I'm really glad our conversation focused on this set of ideas, the philosophy. Dimensional, obviously, as an asset manager, there are a ton of talented people in the firm. We take that philosophy and we bring it to life every day. The portfolio managers and traders, the people in our research group, people like me who, work with advisors, go out in the field and tell our story. But at the end of the day, it is the set of ideas that's most important. And we're just really proud of the idea that, again, nobody owns those. Anyone can put them into motion. But if you are excited and energized by these ideas, Dimensional and the advisors we work with, I'm going to bundle us all together and say, I think collectively, no one has been delivering on this philosophy as long as all of us have. And I think that experience can really benefit investors out there.
I couldn't agree more. And it's one thing to have the ideas, it's another thing to be able to implement them. And I think that's the difference that we see and are awfully impressed with Dimensional, is the implementation, the track results. And I think the same thing goes for advisory firms. I think there's a lot of advisors out there that do financial planning and wealth management, but there's a difference between level and depth of it and really having a true integrated wealth management plan. So I think it all really comes down to implementation. And, Christian, I really appreciate your time today. I've enjoyed it. So I'm hoping that we do round 2 of this in the future.
Yeah, let's do it again.
Yeah. And, but in closing, so my last question for you. So in closing, this podcast is really about helping people get knowledge to help them achieve success where wealth and life intersect. Success means different things to different people. And what it means to be wealthy also means different things to different people. But Christian, you've really accomplished a great, phenomenal career at Dimensional. And I guess when you think about the intersection of wealth and life for you moving forward, what does success look like for Christian?
My answer definitely applies to my work at Dimensional for sure. It has, my work there is not done, but I would say that to some degree, I feel like in some miniature way it's true, but I think it also applies to everything else in my life. And I think to me that the notion of, for a lot of the thinking I do about my wealth and how it sort of drives the decisions I make and how I use my time, I'm going to quote Steve Jobs here. And I don't know if there's a quote behind Jobs' use of this quote. If there is, I'm not familiar with it, but it's the opportunity to make a dent in the universe. He's said that, I think, about sort of what drove him as a very young man and an entrepreneur, and obviously contributing significantly to the birth of the microcomputer and home computing and a lot of other stuff. And so everyone, I think, defines that differently. So I'm not saying I want to make computers. That ship surely has sailed for me. But that notion of whatever your universe is, being able to make a dent in it, that may be in raising a family, that may be in, again, creating an object or a computer, that may be just in telling a story. And that is really, at the end of the day, it's really what I do most of my time at the firm. Is I'm either telling a story to someone or I'm thinking about how to tell the story better. And that project, I feel like collectively for the firm certainly, is never done. We're never done figuring out what's the best way that we can make an impact. So in a way, the dent in the universe for me through Dimensional is, again, just helping people to better achieve their goals in really tiny little ways. I can't help as a portfolio manager or a trader. No one would ever want me to do that. But I think I can contribute, again, in thinking about how we think, right? The philosophy of the ideas, making a dent in that. And again, there are a lot of other very talented people at the firm who've made dents way bigger than mine, but the opportunity to make a dent in the universe, to me, that's just, that's what gets me out of bed in the morning. And it definitely drives, how I think about what can I do with the wealth that I have and how can I put it to work.
That's awesome, Christian. Again, hey, thank you so much. And again, your framing, your analogies, your movie quotes, that was awesome. So I'm 100% confident this will help our listeners. So again, thank you very much and look forward to doing this again with you sometime.
Thank you, Tony.
Do you want even more ideas, tools, and resources on how to achieve the next level of success in your wealth planning? Check out wealthandlife.com, where Tony will cover the latest trends and wealth planning best practices for successful business owners, families approaching retirement, and comprehensive wealth management. And by subscribing to the Wealth and Life podcast, keep up to date with future episodes. Get it all now at wealthandlife.com. Wealth and Life is created and hosted by Tony D'Amico, founder and managing partner of Fidato Wealth LLC, a registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations. To determine which strategies may be appropriate for you, please consult a financial planner prior to making any financial decisions. Any case examples discussed are hypothetical, and any resemblance to a particular person or business is purely incidental. Please visit wealthandlife.com for other important disclosures.